to listen to Chantal and the Fairtree team. So let me quickly take you through our views and what we are. Let's quickly just start off on the past 12 months until 31 March 2025, what type of returns we did have in the market and what we could possibly expect. So in the last year, just to quickly give us an update, it's been actually a phenomenal year in South African Rand terms. Yes, the past month or so has been quite volatile, even the past 3 months. But if you zoom out over the past year, the All Share Index gave back 23%, or gave us 23%, listed property 20%, bond index 20%, and then cash 8%. The one that actually lagged was the developed market world, only giving us 4% in Rand terms. But overall, your South African clients and your South African portfolios should have done quite well. 3 out of the 5 major asset classes delivering 20 in excess of 20%. The past 3 months, however, it changed ever so slightly, not too bad yet, but the month of April was drastically different. In the past 3 months, 6% still in the South African market. So year to date, that was 6%, negative 3.5% in the property market, and negative in world market terms in Rand. If we take this over to the USD portfolios, you'll see extremely subdued performances over the last year until 31 March. Developed world delivering 7%, emerging market 7.6%. There was an ever so slight change of emerging market being favorable again. Then developed property only 4%, corporate bonds 4%, government bonds 2%, emerging market bonds 6.4% and 5%. So subdued performance, not what we are used to in the USD markets. We are used to in excess of 10 to 15% US dollar returns in the developed market. And if you take singular points in time, that could have been in excess of 20-25%. There's definitely been a shift, especially in the last month. Developed market returning negative 4.4%, emerging markets 1%, and developed market property negative 2.3%. So that's just where we came from. I'm not going to go into so much depth as Chantal. I think they're doing a great job there, and we give that to the fund managers to do. But from an investment committee perspective, we need to understand where the world is, where the world's going to go maybe, and what the possibilities are, because we want to manage risk in the portfolios. So what do we see? What do we get from all our active managers out there and all our inputs from our independent committee and our independent economists that gives us some guidance? The main thing is that we have a tail risk of headline inflation picking up. And if you look at that light green graph, we've got a possibility of inflation in the US going up. As Chantal said, to actually look at the data and the specific point, I think it's a futile exercise. The main thing is we've got a risk of rising inflation. Why would that be? Quite simplistic, it's tariffs. All these tariffs going around, and we don't actually know the end game of where the tariffs will stop. That is an inflationary thing. So if your Apple iPhone goes from $2,000 to $2,500, I promise you Apple's not going to pay for that. The consumer is going to pay for that. So we are getting this inflation that's actually sticking its head out. But we also think that this possibly could only be a base case scenario. What I mean with that is tariffs will be implemented in the next 6 to 9 to 12 months, timeline independent. But once those tariffs are implemented and the world has became aware of the new normal, we will have a baseline inflation coming up. But the year after that, the tariffs will already be implemented. And from there on, we should see a comfortable inflation number coming out again the year after this. So we've got this inflation picking up, but we do believe that the Fed and the central banks of the world do still have enough fire ammo to manage this inflation and not actually hike inflations. If we look at the US in specific, where most of the tariffs and the consumer we believe will be hit the hardest, end of 2025, we believe there will be no interest rate cuts. That pinkish line was the latest number. The greenish one is at the end of 2025, and then at the end of 2026, we do see a ever so slight interest rate cut again. So that's just what we think about the markets. That means we still believe developed market equities will be under a bit of pressure, especially in the next year, with all the tariffs, with all this noise going around, and to actually settle. If we look at the federal rate expectations, that's that darkish blue line. You will see the green line was the market's expectation. So the market actually expected more cuts than the Fed actually said. And now suddenly the market is not actually pricing in any cuts anymore, but the Fed still holds steady that they will be cut in future if the time is right. We just don't see it in the next 12 months. If we just go over to from the South African 10-year yield, something I would like to mention on the whole Trump thing. He is a property investor by heart. That's how he made his money. He is quite aware of the US 10-year Treasury yield. That is the borrowing rate of the world. That's the borrowing rate of the companies in America, and that's even the borrowing rate of the government itself. And he is quite aware, and that's on the left axis. It's sitting at about 4.5% at the moment. He doesn't want that to go over 5%. There's a lot of debt that needs to be rolled over, that he needs to refinance, and individuals in America will need to refinance in the next 2 years, and he doesn't want that to run away from him. And I think that's why it paused on a 90-day tariff yield, that he is quite aware of this specific yield. From a South African perspective, however, on the right axis, we were down to 10% on our 10-year government yield. That's post-GNU, so we moved quite down. That just simply means the world sees us as less risky. So they will actually take a less yield at borrowing us some money because the government is less risky. There isn't that huge political risk. That has ever so slightly picked up again. And if you look at the yield curve, that's the graph on the left-hand side, it's actually quite interesting to see. The lightest green was the yield curve. It's simply simplistic, the time period that you want to borrow money for at which yield. And then on the greenish one, you could see the 10-year yield running around at 11%. Then suddenly post-GNU, we dropped all the way down end of Q3 2024 to a yield curve there at 10% on the 10-year yield. The interesting thing, however, is end of Q4 2024 and the first quarter 2025, we have this whole yield curve has been shifting up again, which tells us there's more risk in the South African government with these political uncertainty about the post-GNU. But we still believe there's some opportunities in the South African bond market. Interesting to see, speaking directly, as Chantal mentioned, this is the returns since 2015 out of the different markets. We've got the MSCI US, the world and the emerging market on top there, and the South African market at the bottom there. No real returns there, but we had this great pickup at the end of 2023, and then obviously post-GNU as well. That still means we are attractively valued, but we have 3 key risks, and that is the geopolitical tension Chantal spoke about, the Trump era policy volatility. But as she said, we don't think we are as directly in the fire as a China or so forth. So even if AGOA plays through, it's going to be a shift. It's going to be a shift of our exports, of our agriculture, the transportation, the PE whole debacle that Chantal spoke about. But there will still be routes. There will still be exports for South African, as that is a very small part of the total exports. And then obviously the biggest one is the domestic correlation instability, and the bear case is that that will go on as not one of these political parties can actually afford to not be part of the GNU at this moment. Thanks to Stanley. There's a few graphs that I just would still like to show about on South Africa. This is the manufacturing production index. This is mining and manufacturing since 2004, and it moved absolutely nowhere. Chantal also touched on this. There's no R&D, no capital expenditure made in these 2 areas. The only thing that saved us basically was retail spending. We had a great pickup at the end of the year. The big thing is that only a 2-part system inflow that we got, a tailwind that we received, or will actually the South African people, the South African consumer be in a better position to actually support this retail spending? But we need manufacturing and mining for a proper GDP growth. The big problem obviously also is the government debt at the moment. We're sitting at, it's an annual growth of about 14%. 1.3 billion rands a day of debt that we pay in interest rates. That's an enormous amount. That's something that we need to address. We are sitting at 85% of debt to GDP. America is sitting at 150. So once again, it's controllable. Once again, our South African government or the Reserve Bank actually staggered our debt. So there's no maturity, and 90 to 95% of our debt is actually ZAR denominated and not USD denominated. So as the Rand and the USD, the Rand exchange rate actually fluctuate, it doesn't impair our debts. The problem is we wanted to build 2 new universities, and they said, no, we can't do it at the moment. We don't have the capital. And then the question was actually asked, but how much does a university cost? And the answer came back about to 1.1 to 1.3 billion Rand. That's what we spend in interest rates in a single day. So it's a growth problem. So if we can get our debt under control, then our growth will definitely come back to fruition. How can we get this growth back? And Chantal touched on this. It's obviously our corporates. Our corporates is sitting at a record amount of cash on their balance sheets. And I would like to touch on this last year, especially with the high interest rates we're receiving at the moment. We're sitting at just below the 1.4 billion Rand of cash sitting on the corporate's balance sheets that they don't want to employ because they don't have the confidence at the moment in South Africa infrastructure and South African politics. That could possibly change. The scary thing is that these corporate deposits have grown at twice the rate of inflation since 2020. So post-COVID, corporate cash deposits, reinvesting the profits that they're making into cash, and obviously the interest rates on that cash portion as well has doubled inflation. And that's a big problem at the moment, because if you are a business and you are earning double inflation from the safest place that you can actually be, why do you want to deploy cash into infrastructure or a new idea, into a new mining facility or anything, because you're actually receiving double-digit returns for your shareholders just by holding on to cash? And we need to change this. We need private and public combination to actually work together. The big thing is, will it actually work? And the answer is an emphatic yes, it will work. If you just look at the solar energy problem that we had, we all know the story about Eskom, about the old stage load shedding. And then actually what happened, they said, okay, private companies, you can produce your own energy. And they started off with a very simple thing, about 10 megawatts or something, then 100 megawatts. And then they said, okay, it's unlimited. You can actually solve your own energy problem. And this was the spending of the private sector into mostly solar energy since 2022. And from 0 megawatts in production to just below 12,000 megawatts in production. And I know Chantal showed this from a different angle. And this is what can be done if we can unlock that extreme balance sheets of the company. The biggest thing, however, for South African equities is we need to get the cumulative foreign buying of South African equities back. This was phase 1 post the apartheid era, 1994. We had some massive flows into South African equities as we transitioned. Since then, it was actually quite flat. Since 2009, post the Total Trevor Manuel era, Jacob Zuma era, and since then, it's actually quite negative. So we are getting less and less and less foreign buying of our South African equities. And the one thing to get right is this GNU to open the infrastructure and the country for private investing, and then we'll get these flows back into South Africa. Tariffs, we've actually talked a lot. I'm not going to go into depth of this. Just a bit of history on the tariffs. So that is the actual only way that countries received income was through tariffs. So back in 1820, with all the wooden ships sailing across the world, you would have come to a harbor, you had your products there, and then the harbor collector will actually take a tariff on everything that you wanted to import into, let's say, America. That all changed in 1913 with the introduction of income taxes. Although there were income taxes since very long ago, the efficiency of collecting that type of income taxes actually just increased, and they started getting income taxes instead of tariffs. Tariffs is at a total low at the moment, and as Francois actually asked Chantal, which was a great question, is what's the end game of Trump? And I think there's method in his madness. It's just the way he's doing at the moment is not the correct way of doing it. What's the biggest countries by import actually to the US? And you will actually note this. This were the first 3 countries that he actually, sorry guys, I'm just quickly want to touch on thing. So that's the first 3 countries that he actually tariffed was Mexico, China, and Canada, because they are the biggest importers. And he's trying to eradicate a trade deficit of about $6 trillion at the moment. So he's trying to do that by tariffs. He's also trying to do it by a few other stuff. The efficiency, Elon Musk in there, he's trying to basically get that $6 trillion trade deficit down to about 3 billion. And as Chantal said, they were carrying a lot of countries and helping a lot of countries from their balance sheet, which may be undue or not. It depends on which way you look at it. Did it actually work, the tariffs on the Trump era? This is the construction spending in US as a percentage of GDP, and there is a definite pickup since his first election, Trump 1.0, and post-COVID, when they were relying quite a lot on the infrastructure and supply chains of the world. That actually changed quite a lot, and Trump is trying to get this right. The interesting thing on Trump, if you look at the US business sector, there's about 30.8 million small businesses and only 19,600 large businesses in the US. And the job growth out of that different sectors actually came from small businesses and not these large mega businesses. And it's these type of businesses that actually voted for Trump on the slogan of making America great again. And they were of the idea, and they are still of this idea that Trump will actually make America great again, and it will assist these small businesses in becoming these types of large businesses. What did the confidence look like in these small businesses? It actually picked up post-Trump. It's the highest in 23 years, but it did actually came down quite a lot with this tariffs. And the one reason is this US trade policy uncertainty. And they don't have a clue what's coming next. And if you think about it from a company perspective, let's use one of these large companies as an example. You've got Apple. So you are tariffed 145% anything that comes from China. So you've got 2 choices. You can move your manufacturing plants to India or to Taiwan or somebody else that you hope Mr. Trump won't actually tariff. Or you can invest billions of dollars in a manufacturing plant in America. And that's obviously what Trump's hoping for. But now you're sitting with, from an Apple perspective, once again, and you need to spend billions and billions of dollars of building this manufacturing plant. Probably going to take you 2 to 3 years to build it and get it actually up and running and efficiently running. And then the question is, 4 years from now, 3 years from now, do you actually think that Trump will still be in charge, will still be president? I don't think so. And then that's a big problem that the people are sitting with, uncertainty going forward. US confidence, it actually one of the lowest points in the past month. Was actually quite low. They are sitting at about 60% of the 100% index where they should be. So the consumer is also quite negative at the moment, with the expectation and inflation expectations picking up on the latest survey of the Michigan inflation numbers. So that's a problem we are sitting, but this actually comes with opportunity. The opportunity lies at Q1. We were sitting at the start of the year, the S&P 500 was sitting at a 22.5% PE. Your annualized returns for the next 10 years, on average, if the PE is as high as it was, is actually 0%. Currently sitting at a 17.5 PE, it's actually a bit more cheaper in the past few trading days, sitting at a 16 PE. And once again, you are getting annualized returns of in excess of 10% in dollar terms. And that is an opportunity. So what is our asset allocation calls based on this? We are still slightly overweight ASA equity. We think the tariffs and the global world trade war won't affect SA equity as much, as Chantal said. We still think there's great companies, and the valuations is once again quite cheap from a South African perspective. The GNU is still in place. The GNU actually made the right noises, as that survey showed from Chantal. 60% of South African voters is actually more positive post that. And we don't think our base case is that it will fall apart. So we're still slightly overweight. We still overweight SA bonds. From that perspective, once again, a nice pickup in yield sitting at 11%. We received 20% in the past year from SA bonds, and that could possibly happen again and then show it again going forward. We're still slightly underweight DM equities, but we are looking for opportunities. but we are still for the next quarter or at the moment sitting at an underweight position. We think this trade war can be an extended trade war, can be an extended tariff war, and I'll show you now what we've actually done. Emerging markets, there is some opportunity that we're trying to unlock. So what is our views? It's actually, there's no specific very strong view. It's about diversification, but through fund selection and not through tactical tilts. We're not chasing alpha, and I've showed it in a presentation before. We're not chasing alpha on tactical tilts, but we are chasing it actually on fund selection. Sorry guys, this is a grass lawn mower running. I just want to shut it down. Sorry. So what we actually did is in the DM equity space, we believe in active and passive management and a combination of these. We've showed this before, but we had this great all-rounder playing for us, Roger Federer. What we actually did at the end of last year is we brought in a specialist still in equities, still in a defensive position, but we just brought in the best defense player ever to play on court, and that's Rafael Nadal. What do I mean by this? Vergelijkingie is basically that we have a defensive position. So from a developed market equity, we're sitting at 26.5% in the balance, in the moderate solution. 16.5% is still in the Satrix passive solution to keep the fees low, and we still strongly believe it's one of the best investors because you can't time the market. Then we have two active managers in there, Fairtree Global Equity, as well as the Ranmore Global Value Equity. And that's our defense player, and we've got a nimble guy, Fairtree Global Equity, that is actually taking emerging market allocation when they see fit and when they see some enhanced returns there. From a perspective, we're sitting at 60% passive and 37% in active, 62 versus 37 active passive. And if we look at the passive guy that we actually brought in, sorry, I'm just going to run through this due to time. That's why we have passive and active, the active. And this is exactly why we brought in our Rafael Nadal in the global equity space. This is the Ranmore Global Equity Fund. So the fund selection team, we are, as once again said, we're totally independent, had the agenda of finding us the best defense player in the global equity space. This is a very simple statistic, just to quickly explain it. I've got 4 minutes left. This is the upside capture ratio. So if the market goes up, how far does that specific fund goes up? It participates, it goes actually up more. But when the market goes down, and this is the downside capture ratio. So if the market goes down 100%, how much does this fund go down? And it actually is totally uncorrelated. That's over a 1 year period. Over a 3 year period, it only went down 20%. So the drawdown is exceptionally well. In a 5 year period, it actually went down 50%. So if you look at the drawdown of our defense player in a volatile market, it actually went down negative 12% versus the all country index or the global equity general guys of negative 18%. Did we give up on returns? No, we did not. Over a rolling 3 year return, the Glenmore Equity Fund is one of the best returning funds in the space. And that's the Satrix World Index, a constant first to second quartile performer in any cycle in any market. This is also just the same degree, just on a different graph. This is the return versus standard deviation. So for the same risk in a total different playing area, the fund is actually returning excess of our fund watch list, and it's totally uncorrelated towards our other active managers. These are our watch list. I can show this. We are invested in some of these funds, and some of these are short on our watch list. It's the best of the best. And it's just to show the technology. The fund that we actually choose, the Ranmore fund, was sitting at 3.2 technology at the end of February, and that's why it's doing so well. So not by doing active asset allocation, but by defending through a proper fund selection perspective in this uncertain markets, by diversifying across all asset classes, what the funds actually do. And I think it's exceptional returns, all local solutions outperforming the category average quite significantly. And with the moderate solution, where the bulk of the money is returning over the past year, 16.35% versus the average multi-asset high equity investor of 12.3%. Over a 5 year period, basically 2% alpha, and over a 5 year cycle, and even over 3 years, some exceptional returns. So the funds are doing well. They're defending by not doing big switch decisions, just by being smart, just by doing great fund selection. Just quickly want to touch, I'm going to run through this in 2 minutes, so please give me time. This is just to a behavioral finance to end off with. Never trade in a panic. Why do we say that? The US stocks have gained nearly 80% since October 2022 lows, and a true market correction hasn't occurred since October 2023, and that's the market return we spoke about there. The market will climb a wall of worry. It will climb through tariff walls. It will climb through different regimes. And this is the most, I wish I could post this graph on each advisor's wall. This is the returns of the S&P during 1980 to 2025. Each single red dot shows the maximum drawdown in that specific calendar year. And the grayish buildings at the back shows the return at the end of the year. And in every single year, you will see drawdowns of 20%, -5, -34. But at the end of the year, you still have positive equity returns. Out of the past 45 years, there were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 out of 45 years that actually ended the year negative as well. But once again, each year the drawdown was actually bigger than that specific calendar year's return. You all notice, just to end off with, as the last graph, then I'm going to stop sharing. Missing the market's best days has been costly in the S&P 500. This is since 1995. So this is, I had to do maths again, 29 years of data. If I'm correct, yes. So 29 years of data, let's call it 200 trading days per specific year. It's 5,800 trading days. If you invested $10,000 through that specific time, through a lot of market crashes, your end value would have been $224,000. If you missed the 10 best days, you would have had 54% less than just staying fully invested. If you missed the 20 days and if you missed the 30 days, you actually 30 days out of 5,800 trading days, you would have had $38,000. When does these best days actually occur? I'm going to end off with that. 50% of the best days of these 10 best days actually happened during a bear market. Another 28% happened in the first 2 months after a bull market. So that 78% of these best days is actually happening as we speak, as we're happening in the market. And it actually happened 2 weeks ago when the S&P or the Nasdaq did 10%. So just due to time, I'm going to stop the presentation there. And I will take any short questions if needed. Thank you for listening. If there's any more information needed, please contact Elmarie or myself. Francois, thank you.
Yes, thanks very much, Steph. It's interesting. There's something that you mentioned or somewhere near the beginning of your session that you said, and you made it abundantly clear that we're not chasing alpha, yet the results do show alpha, which I think then speaks to the fact that, probably you're not throwing darts at a dartboard when you try and choose funds, right? There's a specific process that underlies all of this success up to this point. Don't you just want to maybe just highlight exactly what that process is again, just in a summary fashion, just so that everyone's clear around how you go about this, although you did touch on a lot of those maybe throughout the session, but just maybe I just wanted to be abundantly clear.
Sure. So 2 things that we believe in actually is, one is, do you actually believe that one single asset manager can be the best in managing global value equity, global growth equity, South African growth equity, South African value equity, South African bonds, South African income? And if I ask the question to any advisor actually listening and I ask them, which South African equity fund do you back? I promise it's going to be one of 5 funds. It's probably going to be Truffle, 361, Fairtree, and there's a few other, maybe a 91 SA equity or something like that. And then the same question comes, if you back an income fund, which one would you choose? And I promise you, it's probably going to be 5 different asset managers that you choose in a different scenario. And then you ask the question, okay, in a balance fund, which one do you choose? And it's not the same names. So we strongly believe in a multi-manager or building block approach. We get to leverage these specialities in each specific building class and building asset class. And through that, to answer your question, I think it's the process of actually analyzing the funds, understanding the market, and understanding what the fund managers actually do in different cycles and in different markets. So choosing the Ranmore Fund, according to us, is a great move in a volatile, extreme market. And that came out through stripping out global equity into different managers, different styles, and understanding actually what they do and how they combine with an active or a passive solution. So to answer your question, how do we do it? Back the jockey, back the fund manager, understand if you invest in that fund manager, what they actually do, and back them to do their job. And then trying to overlay that by being smart yourself. Do the process correct and the returns will come.
Awesome. And be consistent. I stick to that. So then maybe my last question to you quickly, Steve, is DFMs are everywhere. It feels to me like, they're sort of everywhere. What is the value in working with an independent DFM as opposed to a DFM that might be part of another solution in that sense? So they're not completely independent, but they might form part of a bigger group, for example. But what's your view on the value of a truly independent DFM?
The independence. I'm just joking. The thing is, I think your mind gets skewed, and then it's normal. Biases set in any investment process and in any investment committee. If you get the same news and the same information and the same processes thrown at you at every single quarter. And that's the one thing about being independent, is we get different views at different times on different aspects of asset management. And by being independent, I can really gauge and touch and understand a Fairtree's equity mandate versus a 361 mandate versus a Truffles mandate, and to understand where they fit in. And by not being independent, I'm always going to get the views of, let's call it, a growth manager. But by being independent, we can get independent views to actually choose the best of the best for the clients out there on an independent way. Yeah.